Greetings, Dr. Jeffrey Scott here, and this is my weekend market update for March 5th, 2023. Actually, doing this on Saturday the 4th, had some extra time. That's me in the lower left-hand corner. I am a doctor. I'm involved in healthcare technology and value-based care, and that's me speaking just a few months ago at a healthcare conference. Uh, what a week! I thought of all kinds of topics: bear market rally versus new bull, bull trap versus off to new highs. But then as I looked at things, it was amazing. I felt like I was back in 2021 where growth was leading. So I put it, growth is back, but is it a bull trap? We'll talk about that. I'll show you the data for pro and con as we go forward. For those that are new, welcome. For those who've been here a while, thanks for coming back. Um, Either way, you should hit subscribe in the YouTube channel and then hit the alarm and you'll get notice when I submit these. Kind of haphazard when I put them up. It really depends on the number and depth of the honeydews I have on a specific weekend. My email address is hgsidoc@gmail.com. I welcome positive and constructive negative remarks, and I reply to anybody that sends me an email. I don't do this for money, don't really care how many subscribers I have, but I want to create value for the time I put in and the time that you put in for being here. This is for education purposes only. Anything I talk about should be taken in that light, in the spirit of education, and not be considered investment advice. I'm a doctor, not a broker. I have an MD degree. I'm board certified in internal medicine and oncology, but I have none of the broker licenses that would allow me to tell you what to do. I am independent. I have some tools that are in wealth charts. Um, I've got tools that are in a couple of other programs as well, but I don't get paid for those tools. I pay for the things that I use. And the only thing I do sell are live education once or twice a year. And then there is an a upcharged add-on called a marketplace add-on within wealth charts. Trading involves risk, and you are solely responsible for any decisions you make. Keeping in vein with free education, I do put something out Monday through Friday mornings on stocksanddocs.com. This is in conjunction with the folks at becomeabettertrader.com, and it's something I'm doing, just looking at the market from the busy professional that I am and how to not go 40 minutes like I do in this YouTube video, but how you can cut it down to 10 minutes a night and keep abreast of the market and manage your portfolio. Couple of old Ian slides. Ian was such an important mentor to me, Ian Woodward. Um, I grew up playing chutes and ladders. Ian grew up many years before me, but in England where they played snakes and ladders. And the point of this slide, especially as we are starting to wonder, are we in a new bull run, is to remember that how important your money is. And if you lose 90% of your capital, you have a long time and a challenge to get back to where you started from. It's okay to play with a game where if you land on 28, it takes you up to 84. Woohoo, that's great. And occasionally you'll get a stock you got a big position that's a takeout or gets a drug approved, and you'll see that kind of a return. But you can't survive for long if you land on 87 and get dropped down to 24. So money management is key. Preservation of capital is the goal. And the other thing is, I probably saw my best week in quite some time last week. I'm sure many of you did as well. And it reminded me of, is it because you're good and I'm good, or is it because we're in the right direction in the right market? And I'm going to go with the latter. And this is something, if you've seen me on wealth charts in the intensives or any of the quarterly Wealth 365 events, goes back to the 90s where smart people sat in a room in the Palos Verdes Estates Library And every month they came up with some stock picks. And then retrospectively, they went back and they looked at those stock picks, and retrospectively, they would characterize the market into four categories. When you look at performance, it wasn't the difference in technique, it wasn't that they got smarter or dumber at different years, but it showed that it was the market, and that in a very strong market, 20 days representing a month, you could actually double your money. And in a weak market, you could lose substantially. Now, the other message here is in a weak market, it doesn't get better if the market stays weak. There's no reason to hold on until I get back to normal. It's not going to happen. But if you get a big gain right out of the chute and you look at how much it's up after 2 months, take your profits early because you can always leave a half or a quarter behind, and maybe you've got one of these new true market leaders. But you want to take profits because, as we're seeing in this market, so often these gains turn to some pain. Now, if you go back and look at Tuesday afternoon, I was talking to somebody, I think it was Tuesday, and then at 1 o'clock, excuse me, mid-afternoon rather, the market started going crazy. And I was trying to figure out what changed, what was so important. Well, it was a Fed speak, and I guess in the essence of the Fed giveth and taketh away, Waller called out progress in reducing inflation. Further improvement is coming. Talked about 3-month better than the 12-month, so that was better. The second bullet point did call out concerns about consumer spending and that inflation is not coming down as fast as he thought. Then commented that next employment report and CPI release ahead of the March 21st, 22nd FOMC, and that will affect his assessment. So perhaps it was reiteration of data dependency, but that's when the market, to me, seemed to change. And for the last several weeks, every time a Fed leader spoke, the market sold off. So that was a change. Let's look at the markets from this past week. I think it was a 5-day week. It's hard to keep track. This is the part of the year that we get lots of holidays. Short month, but a 5-day week. First thing is you see tons of green on both the indexes and the sectors. The losers on the week was the dollar, down 0.6%. That's good for markets. And Bitcoin was down a tad, not a big difference if you look at the Bitcoin GBTC ETF. In yellow, you see the major indexes, and you could see they were led by the NASDAQ and the Russell. You could see biotech had a great week. Excuse me. The big champion of the week, as we've been talking about on stocks and docs, was natural gas, which was up 16%. And you can play that with BOIL, which is a 3X ETF, and you would have had a pretty significant move. ARC Innovation, which is small cap growth, Cathie Wood style, was up nicely as well, as was the IBD 50 ETF. Oil also up 4%. So it was a fairly strong week in the markets. Now over here on the left, on the right rather, you could see that we're actually approaching new bull market territory across the board off of the October 13th market bottom. Now, will that hold and be the new low for this bear? Or are we just in a bear market rally and we're going to go back and retest? I'm going to let you come to your own decision on that because I think it's pretty pivotal. But I do think it's related to recession. And let's take a look at some data and see how we can start to think about that. Now, one thing that was crazy to me was notice this fall in the S&P was this rise in the interest rates. We're now going up in indexes while we're going higher in rates on both the 10-year and the 30-year. Now, yes, there was a little bit of a slowdown at the end of the week, but isn't that interesting? We're battling through higher rates and going higher. Now that disconnect would obviously be great for the market if that continues, especially if rates go higher. Rising rates are good for banks, especially regional banks and insurers. Now, two of the things that I look at, among other things, are either the 10-3 or the 10-2 yield curve inversion, and then how tight money is using the high yield options adjusted spread from Bank of America. Both you can get by just going to Fred and typing in yield curve or something like that for the left and high yield index on the right. These gray lines here represent a recession. So the point I wanted to make is going back to here's 1990. Whenever you get an inversion, you get the gray bar. But you don't usually get the gray bar until that inversion is resolved. And why would the inversion resolve? Because the economy is slowing down and the Fed is cutting rates, and then the short duration bonds will fall fastest. So to me, where we're at suggests that we do have a recession coming, and that would make the bear, perhaps worse. Now you can look here and go, why did we have a recession in 2018 if we didn't have an inversion curve? Well, you can get recessions that are for other purposes, and there was some credit tightening that may have been related to that. Short-term breadth, stocks above the 200-day, stocks above the 40 hooked up, so they improved a little bit. But the big one was the T2121, the 13-week new high, new low, which really moved up towards the overbought area. Still can go higher, but at some point we're going to start knocking on this line here, and I'm going to start telling you that I'm going to be careful. Another way of looking at that is the buckets, putting the stocks in the S&P 1500 and looking at deciles, how many stocks are in each decile of their Bollinger Bands from 0 to 100, and then how many are below, small number, how many above, small number. You're looking for something that shows too much one way or the other. It's a 50-50 market, a little bit favoring the bears, but really nothing that's telling me it's going to lead to a reversal. Hindenburg. During 2022, we had lots of new lows and rare new highs. Recently, during February, we saw the new lows creep back in, and that was not very good. Now, it's only one day, but on Friday and Thursday, we saw new highs, with some new highs the prior 2 days, and the new lows are vanishing. That is a good thing. Why did we see a Hindenburg omen on the NASDAQ on March 2nd? Hard for me to say. You usually don't see them until you get to new highs. I'm going to just attribute a couple of things. One, typical of the Hindis on the NYSE. I use the NASDAQ as well because the markets are so different of what the constituents are. The second thing is we did have a pretty big run up. And the third thing is I wonder how much of that is saying there's still a lot of risk in this market. On the NYSE, you don't see a Hindenburg, but you do see a lot of new highs coming back in. Now, I made a comment in the beginning, the markets feel like 2021. Why? Because I'm a growth guy. This is taking all the stocks in my data set, which is over 10,000 stocks. It's putting each of them in a ERG bucket. ERG is a combination of EPS rank, which can be 0 to 100, relative strength rank 0 to 100, it's really to 99, and group rank 0 to 99. You add them up, and for a growth stock, you'd like to see the curve to go in the direction it is. And we throw out the tail and we throw out the head because the number of stocks, as you can see in the fainter gray line, gets down to close to 0. But if we look at the heart of this, most of the things are up, and the higher ERG, the better we perform. That's a great story. EPS rank outperformed. Relative strength, still kind of weird. High relative strength stocks did well, but stocks that are turnarounds have no relative strength. Maybe recent stocks, they actually did well too. Now, the other thing is this is about probably 60 different watch lists that I follow. And what I ran is this thing in HGSI called the Group Performance Analysis. And I asked on the different lists that I built out on the weekend of the 25th, 26th, um, how did they perform going forward this week? And by the way, the ERG report here is also based upon the same data set taken a week ago, not taking the best thing and saying what was best, but looking at a week in advance to see if you could predict. I mentioned that I had a surprising week. Well, when you can be up on 10 out of 11 stocks, and if you look at some of these various watch lists, I wasn't the only one that had a super high percentage of gains, and I hope you did as well. Um, if you look at my high relative strength leaders, they were up 4.18. Some of the IBD lists, the IBD 50, the Market Smith, IBD 85, the weekend review, were all up 2% and higher, almost 3 and higher. And even though it was up a lot, S&P 500 lagged. Remember when I showed you that initial chart, I showed you that growth, technology related growth in the Qs and the NASDAQ composite and small stocks actually outperformed. Now we've got some speaking this week. In fact, we already had a talk, or we'll have a talk today at 1 o'clock, probably PST. San Francisco Fed President Daly is speaking. We've got Powell to Senate on Tuesday, to the House on Wednesday. So those are three exogenous events unrelated to data that could drive the market. We have some big data. We've got ADP employment, JOLTS, jobless claims, employment report this week. So there'll be more data pieces, not perhaps as big as the CPI that's coming up, but more data for the Fed to look at. You want to find the economic calendar, go to marketwatch.com. And then from earningswhispers.com, and here is a link that you can go to. You can get a list of the stocks that have earnings this week, and there's a lot of them. So it's another busy week. And it's a judgment call to hold the stock over earnings dates. My philosophy is if I have a big profit in it, I might close my eyes and watch it through earnings. Closing my eyes is a bad comment. I might acknowledge the risk and hold it. A lot of times, like I have a pretty big position in CECO, I took off half the position because I've had a nice run on it. Earnings are Monday before the market opens. I could have market goes against me. I could have stocks past, this quarter go against me, or their projections for next year go against me. So I like putting profits in the bank. But I think you have to look at it as how you feel about your position, the position size. I don't like to risk big position size because if I don't want to get such a big down day on one of my stocks and then have it pull my whole portfolio down even if the market had an up day. So the thoughts. Market broke its losing streak despite the ongoing concerns about inflation and rates. Probably some technical buying. I talked all week about support. Inflation was stoked this week by data releases, whether it was ISM manufacturing, jobless claims, productivity, low weekly claims, tight labor, rising prices. A lot of things to get people worried, and higher CPI in Germany. The March is on the 14th. That's going to be a huge date. We've got another week to go before that, week and a half. And I think that the markets, to me, look like they may want to coast into that print. Growth outperformed. It felt like the first time in years. Certainly, we haven't seen a lot of that. But is this just a trap? I added some positions, or added 2 positions is a better way of saying it this week. Took some bigger size. But I still got cash on the side. I'm in zero margin. And I'll let the markets dictate every day how much to deploy. It's interesting that the market seems to be ignoring recent data, rate concerns, etc., and moved higher. So recession, yes or no, is a critical decision point to me. Soft landings occur, but they're less common. We may have seen the bottom, but I think a prudent risk manager might still be cautious. I'm going to show you 3 slides with 4 pictures that are meaningful to me. First sometimes a picture tells the best story. I've showed this before. I am showing in um, blue, going back to 74, each market bottom. I am showing you in black the Fed rates. You will not find a market bottom that didn't occur concurrently or after the Fed cut. Well, Fed's still rising, so that would make saying that we've had a bottom a little bit challenging. The slide on the right says, and I've shown it before, so we don't need to spend much time, the average bear market is this black box. This is where we were when the slide was taken, which was a while ago. This red box, which is significantly worse, is the average bear market occurring in a secular recession. If we go into recession, I expect it to get worse. Let's hope we don't see the recession. And then this is a new thing you haven't seen before. I refer you to YouTube to learn more about it. But I've been watching it of late, and I'm finding it to be fascinating. So I reached out and got permission from Dr. Eurodollar, he likes to call himself, to show this. It's just a picture from his YouTube, but he has created a what he calls a black swan index. Now I begged, borrowed, do anything to get a copy of it, but at this point he doesn't have it on the market. But when you look back, and this is on a weekly chart, and he puts these out a couple times a week, when it goes to red, it's typically the market peaks and then the market rolls over. Here's 2000, here's 2007, and look at where we're sitting. Not only are we red here, we're one of the highest reds ever that I've seen. So when we're in that red, you got to be concerned about an exit. I refer you to his YouTube site. I think this is his handle, at Dr.354. If not, look up Black Swan Indicator, version 3. I watch every video he puts out. Now, he's different than me. He don't like to talk, but he puts up comments. So there's not much in the way of discussion. It's all comments that he puts up on the screen of what he thinks. I did reach out to him. We've interacted by email. He's a PhD chemist in Europe and a very smart person, and he's put a lot of time into this indicator. So I'm going to be watching that as well. And then this is the optimism slide. And if you look at from the S&P 500 bottoms since 1949, the next 12-month returns. Now we're 18% off the October 13th bottom. We have at least that much or much more to go if that is the bottom and we are in that first year after a bear market low. So on to the charts.